Today, SpaceX went public. The IPO price was $135 a share. In the first 60 seconds of trading, it hit 150. Within 2 hours, 168. And it's still moving. Nobody set that price. Not Elon Musk, not the bank, not any one person on Earth. Millions of strangers are arguing it into existence right now. That process has a name, and once you understand it, you'll never look at a price tag the same way again. Meet Clara. Clara teaches AP Economics at a high school in Denver, Colorado. Supply and demand curves on the whiteboard every single day. Her students ace the exam. What Clara has never done is lived it. 6 months ago, she heard that Vega Aerospace, a private rocket company she'd followed for years, was going public. 11 years of building reusable spacecraft. Never once traded on a stock market. Until now. The IPO price was set the night before at $55 a share. A bank had spent weeks collecting bids from big investors, a process called book building, then landed on that number. Clara registered through her brokerage. She was allocated 60 shares at $55, $3,300, her full savings. She hit confirm at 11 p.m. and lay awake for most of the night. She woke up at 6 a.m., already nervous. The market opens at 7:30 her time in Denver. She made coffee, opened her laptop. Every analyst she read had a different number. Nobody agreed on anything, which was not reassuring. 7:30 a.m. The opening trade for Vega Aerospace comes in at $89, not $55, $89. In the first 60 seconds, she bought at $55. Each of her 60 shares just made $2,040 on paper in 60 seconds. Then 81, then 97, then 78, all within 20 minutes. Clara is white-knuckling her coffee mug. She knows the theory. She teaches it every single day. But watching it move with her actual savings on the line is something she has never felt before. She calls her brother-in-law. He picks up on the second ring. "Don't sell. Don't panic," he says. "This is just price discovery." Clara pauses. She knows that phrase. It's in her own textbook. But standing in her kitchen at 7:52 in the morning, she realizes she doesn't fully understand what it looks like when it's actually happening. Let's explain what she's watching. When a company is private, not on any stock exchange, there's no market continuously setting its price. Investors make guesses. Analysts make guesses. The company makes a guess. But there's no live signal. Just estimates and shared beliefs. The moment a company goes public, that changes. Now millions of investors can buy and sell shares every second. And every trade is an argument. I think this is worth at least this much. Cast with real money. The price that emerges from all of those votes, from millions of conflicting beliefs and bets, is the market's best current answer. Not one person's decision, not the bank's estimate. An emergent truth updated with every trade. In 1945, the economist Friedrich Hayek wrote what became one of the most important papers in all of economics. His argument: no single person, no committee, no government has enough information to correctly price a complex asset. But millions of people, each acting on their own slice of information, collectively know more than any individual ever could. The price is the signal that synthesizes all of that knowledge at once. The market is smarter than any single person in it. So why was the IPO price $55 if the market immediately pushed it to $89? This is where it gets interesting. And honestly, a little embarrassing for Wall Street. Before an IPO, the underwriting bank spends weeks in book building, meeting with hedge funds, pension managers, mutual funds, asking, at what price would you buy shares? How many? They use those answers to set the opening price. But here's the problem. The investors giving those answers have an incentive to lowball. If you're a hedge fund, you want the IPO price as low as possible, because you'll profit when it pops. So indications of interest often don't reflect true beliefs. They reflect strategy. And the bank is also being conservative. A stock that falls on its first day is a disaster for everyone. The company, the bank's reputation, the investors who bought in. So there's a structural incentive baked into the system to underprice deliberately. The result, the first day pop is almost never an accident. It's the built-in gap between the bank's conservative estimate and what the actual market is willing to pay. And that gap has a real cost, paid entirely by the company. Every dollar the stock pops above the IPO price is a dollar the company didn't raise. If Vega priced at 55 and opened at 89 and sold 1 million shares, that's $34 million the company never saw. Money left on the table. This pattern has repeated at virtually every major IPO. In December 2020, DoorDash priced its IPO at $102 a share. First day of trading, it opened at 182. By close, DoorDash was at 189, an 86% pop in one day. Hundreds of millions of dollars the company didn't capture, returned instead to the investors who got in at the IPO price. In 2004, Google tried to solve this. Instead of standard book building, they used a Dutch auction. Any investor could submit a bid. I'll buy X shares at Y price. The theory? More voices, a truer price. Google priced at $85. It still closed its first day at 100. The Dutch auction helped, but the pop didn't disappear. Because price discovery doesn't end at the IPO. The market keeps arguing. Every second the exchange is open. And then there's today. SpaceX, the most valuable company ever to go public, priced at $135 a share last night. The IPO raised $75 billion in a single night. That's the largest IPO in history. Saudi Aramco set the previous record, $29 billion in 2019. SpaceX raised more than double that. And this morning, when the market opened, 135 became 150 in 60 seconds. By mid-morning, SpaceX was trading at $168, up more than 25% from its IPO price. The argument is still happening. Every trade is a vote. The market is still discovering what SpaceX is actually worth. Part of what makes SpaceX so hard to price is that it's unlike anything that's ever gone public before. It's not just a rocket company. It runs Starlink, a satellite internet service with millions of subscribers. It holds billions in government contracts. What is the right price for all of that? Nobody knows. And that's not a failure of the market. That's the market doing exactly what it's designed to do. When the future is genuinely uncertain, prices swing. What you're watching on the ticker isn't chaos. It's information being processed in real time, one trade at a time. Back to Clara. By 10 a.m. Denver time, Vega has been trading for 2.5 hours. The wild swings are calming down. It's been hovering between 83 and 88 for the last 30 minutes. The market is converging, finding something like an answer. Not the right answer. The best current agreement. By noon, Vega is at $86. Clara's 60 shares are worth $5,160. She paid $3,300, a gain of $1,860. In one morning, every instinct says sell. She doesn't. She wrote long-term investor on a sticky note on her monitor before the market opened. She closes the browser tab. She has a third period class to teach. The market will keep arguing without her. And here's what she'll be thinking about all through third period, drawing supply and demand curves on the whiteboard. The stock market is extraordinarily good at processing information quickly, but it is not rational in the short run, especially not on day one of an IPO. For a company that's been public 20 years, there are quarterly earnings, management track records, industry comparisons. For a company that IPO'd this morning, there's almost nothing real to anchor to, so the price is driven by something messier: sentiment, hype, fear, speculation. The grandmother who watched the rocket launch on YouTube, the hedge fund trying to front-run the crowd, the retail investor who just wants to own a piece of history. None of them have the same information. None of them agree on the future. And the price that emerges from all of that, from all those different beliefs and fears and bets, is the best answer a human market can give. Not a perfect answer, the best available one. Economists call this information asymmetry combined with genuine uncertainty. The result? First-day prices are sometimes spectacularly wrong in both directions, and the market keeps correcting itself every second as new information arrives, as more votes are cast. Vega Aerospace closes the day at $84.30. Clara's gain, $1,758. She stares at the number, closes the laptop, walks to her last class of the day. She draws a supply and demand curve on the whiteboard. Clean, static, rational, nothing like what she lived this morning. But the curve is right. It describes exactly what happened. The market moved toward equilibrium. It just moved loudly. Let's name every piece of what happened today. To Clara and to SpaceX. When a private company first sells shares to the public, letting anyone own a piece, that's an initial public offering, the IPO, not just a fundraise. The moment a company gets a publicly discovered price for the very first time. The way that price gets found through millions of trades, each one a vote on what the company is worth, is price discovery. Not one person's decision. The market's best current answer, updated with every trade. As Hayek argued in 1945, the price synthesizes more information than any single person could hold. The bank's pre-IPO process of gathering bids from institutional investors to set the opening price. That's book building. The gap between that number and what the market actually pays on day one, that's underpricing. DoorDash is 102, becoming 189. SpaceX is 135, becoming 168, and still climbing. Money the company didn't capture. Return to the investors who got in at the IPO price. It happens nearly every time, because no estimate, no roadshow, no book building process can replace the information that millions of real buyers reveal when real money starts moving. The price of any company, any asset, is never a fixed fact. It's a living conversation, sometimes calm and orderly, sometimes SpaceX on its first morning, moving 25% before lunch. Either way, same mechanism. Clara ends her week having lived the thing she teaches. She'll draw the same curves on Monday, but she knows something different now. That behind every price, there is an argument. A massive, ongoing, never-finished argument about what the future is worth. The next time you see a number moving on a screen, a stock price, a house, a concert ticket, you're not looking at a fact. You're looking at a vote. Millions of votes cast by people with different information, different beliefs, different fears. Thank you for watching. If this made the world make a little more sense, share it with someone who'd get it. And subscribe, because there's a lot more to explore.